Welcome to Bull vs. Bear, the channel where we break down big financial decisions and make them easy to understand. I'm Kleven, the Bull, always looking for opportunities to charge ahead.
And I'm Chip, the Bear, here to keep things grounded and ask the tough questions. Today we're diving into one of the most debated topics in personal finance. Is buying a home a smart investment, or is it the great wealth killer?
We're putting homeownership and renting under the microscope. What happens if you put that 20% down payment into a house versus the stock market over 30 years?
And it's not just about dollars and cents, it's about opportunity cost, long-term growth, and where your money works best.
Let's get into it and see which path builds more wealth in the long run. So, Chip, before we start, couple little notes to put out there.
Okay?
First of all, if you're listening, make sure you like, subscribe, share. Very important.
Mm-hmm.
Second of all, this is not financial advice. This is just our opinions.
Mm-hmm.
Although we do have some pretty solid numbers behind these opinions. Some research was done. Before we jump into the conversation about buying versus renting, do a little recap of the current portfolio.
Mm-hmm.
So over the last week, the red line. We don't like red lines, but we're down a little bit, 3.4% the last week. Some options shifted not so favorably last week.
Sure.
All good. They're going to go up, right, Chip?
Maybe.
Oh. The optimism I love.
That's why I'm here. Is the whole market down, or is it just your options?
The market did end down on Friday.
Okay.
I don't know if it's been like a touch and go with the market. We've had some high days, we've had some low days. I'd say the last week was not my best week, as the chart will show. But I'm optimistic about this coming week. We're hoping for a December rally. That's our hope.
And what did you call it last week? You called it a Santa Claus rally or something?
They call it a Santa Claus rally. So we're hoping good old Saint Nick brings in the green line straight up. We want to see, a 50% week would be beautiful.
So instead of presents and stocking stuffers, he brings a big bag of money down the chimney, just kind of
Yes.
dumps it into your investment portfolio.
Yeah, all $100 bills will be appreciated. We don't want to have to sort through the small currency, so big bills only, please, Saint Nick.
Except in this instance, instead of giving gifts to children, he's giving it to the most needy of all people, stock investors.
We do need it. Listen, the money makes more money, and then we'll do good things with it. Buy Lamborghinis and Ferraris and other good financial decisions.
Yeah, you guys have been famously the most responsible types of people in capitalism.
I'm happy you know about us.
Mm-hmm.
All right, let's jump into the main topic this week, which is housing. Is it better to buy or better to rent? Let's pull up the data. So today's episode, buying a home, the great wealth killer? Maybe, maybe not. Let's talk about it.
I like that question mark, the implied question mark at the end of that.
We're going to have to fire that video editor that forgot to add that there.
Oh. Well, tell me. So 2 weeks ago, we haven't talked since we decided we were going to do this video. We split up to do our own independent research, and here we are again. 2 weeks ago, we talked about this, and over the last year and a half or 2 years, we've known each other for a while, but over the last couple of years, both of us have kind of started to assume that buying a house financially is a mistake when the alternative is taking the difference between home ownership and renting and investing that difference, which obviously has a pretty high return compared to a home investment in most places in the United States. I was pretty confident going into this research that buying a home was the great wealth killer, but it's apparently not as cut and dry as I had thought. Is that what you found as well?
Yes. There's you'd have to make a lot of stipulations with whether it's better to buy or rent. I think if you buy one house and you sell it, I think your odds are dramatically worse that it's going to be better off for you. I think once you sell a house, because of the fees involved with selling a house and then buying another one, you take a lot of hits financially. Because realtor fees really stack up. Depending on what state you live in, they're going to charge you, thousands of dollars for document updates, et cetera, et cetera, et cetera. Like I've bought 4 houses, which paid thousands in realtor fees. I've paid tons in paperwork fees. It's just overall, if I had taken that money and put it into the stock market, how much it would have grown versus paying for the realtor.
I see what you're saying. So, okay, so that stipulation implies that if you buy and sell your home frequently, which a lot of
Yes.
Americans do, um, then that's a bad. It becomes. I mean, actually, first off, something I found constantly everywhere was the general consensus that homeownership is not an investment and shouldn't be referred to as an investment. Did you find the same thing?
I would say that's accurate. Yeah.
All
So
right.
I've seen people say that. Some people definitely refer to it. It's an investment in my future, which you could say it is an investment in your future. You are generating. You're putting some money aside in a secure, safe asset. A house is a safe, secure asset. Over 30 years, the price of houses only really goes up. It never over a 30-year period, it never drops.
Mm-hmm. Although there are places where uh, over in many places that is true, and in many places people are living that makes sense. Although I have heard stories about places where uh, homes have decreased in value because a large corporation might have had a headquarters in a region, and they might have had a high number of highly paid executives in that region or middle managers, and a lot of income was flowing into that area. And then when they pack up and close and head out of there, like in situations like Detroit, uh, the entire region can see regionalized economic recession, and house value can in fact disappear.
Yes. Well, that is true. You do make a good point there. And then I would go back to the argument of location, location, location with houses, right? You want to pick good locations for a house. If you are in area, I mean, there's not many places in America where major cities decline like Detroit has. It's kind of like a almost like an anomaly. I feel like.
Sure. Yep.
But generally, and everything we're going to talk about during this this episode is going to be generalized. Isn't like you could have gotten really lucky right before COVID, bought a house for 500,000, sold it 2 years later for $1 million. That's not the average case, right?
All right.
So we're gonna look at everything from an average. At, over a 30-year period, your house will go up in value based on the average.
Mm-hmm.
Could you be in a bad area? Sure, but the market as a whole will go up, right?
Right.
Well, let's look at some numbers. Remember, this is just the average. But these are some of the benefits of buying. You're building equity, stability in your house. You have a location. It's basically like a home base. You can customize your house. Your house appreciates in value. Generally a house appreciates about 2.5% a year in value. You have a fixed mortgage payment, and one thing to remember is you have a fixed mortgage payment, but you don't have a fixed payment. Things like HOA go up,
Mm-hmm.
property taxes increase, so things like that do increase. Homeowners insurance, that one has been a really big increase in the last few years. Um, but you do have tax benefits for houses, and that varies state by state. You can have investment opportunities. If you're renting out a basement, if you have a house, you generally feel more a part of a community, like you have roots in that community. Retirement security is a big one, and then legacy. Something you pass down to your kids. Although I will say that probably doesn't happen as much as people like to idealize it. I think generally when you get older, you sell your house and you downsize. So the house you were holding as a legacy house, you're going to get rid of anyway.
Mm-hmm.
Um, some benefits of renting, flexibility. If you have a better job 3 cities over, you can get up and move. Not really hard to do that when you're renting. Your upfront costs are a lot lower. Maintenance free. Your refrigerator breaks, call the landlord. You got a new refrigerator. AC goes out, call the landlord. They fix it. You have a predictable cost. Your rent is locked in for whatever time period you have. Now it will go up after that, but you know exactly what you're paying for a year or 2 years, depending on what type of rent agreement you have. No property taxes, not something you need to worry about. You have access to amenities. Now, homes can have amenities too if you live in like a housing community with a robust HOA with some pools and gyms. Generally, apartments or condos have better amenities, buildings like that have pretty good amenities.
Mm-hmm.
Short term commitment, freedom from the market risks. If the housing market ever crashes like it did in 2008, you're renting, you're not feeling any impact of that from renting. No home ownership responsibilities. You don't need to go outside and mow the lawn. Just, your life's a little bit more simpler. You don't have to do all the maintenance the house has.
Mm-hmm.
And then location options. If you buy a house and it's in a good area, 10 years later it's in a bad area, you can't move the house. It's stuck where it is. If you're
Mm.
renting and the area you're renting in goes down, you can just move. Not that hard to do. But these
Yep.
are some of the pros and cons I saw from renting and from buying. Is there anything you think I missed, Chip?
No, I think this is a pretty comprehensive list. Something that I didn't know about until doing a little bit of digging is that and I wasn't sure if there's a term for it, and there might be a term for it. But essentially, there's this concept of a loan being beneficial to the borrower the longer the loan is held. And because of inflation, right? Inflation decreases over time. Inflation functionally, quote unquote, helps the borrower because if I get a 3% loan for a home, like that's never coming back around again, or at least not in my lifetime. But hypothetically, you were one of those lucky few who in like the 2010s to 2015s got a 3% loan for a home. As inflation increases, you could have a $600 mortgage and you have a 3% mortgage on that home, and every year it gets less impactful because inflation consistently goes up, and getting another loan, you're never going to see that rate again. And so it's interesting to see how sometimes holding debt, especially in the form of a mortgage, like a locked mortgage, has some benefits that other types of debt don't have. The housing market in America is it's more difficult. It's more difficult to calculate against than I had thought.
Yeah, I would agree. Before we go through all the numbers, I will say if you have a 3% home loan, it's like a unicorn. You're not. I doubt you. Like Chip said, you're ever going to see it again. And I do think that would be probably more beneficial than renting if you could get that. I think the problem is when you're generally looking at the interest rates. I don't think we're ever going to see 3% again. I think we'll probably be, 5% will be good, maybe 4.5. Um, and that doesn't. I think at that point, then you're probably more benefit. Then it's probably more beneficial to rent. But let's go through the numbers. So let's move over to look at some numbers. So let's talk numbers, 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 numbers.
Wow, this is impressive.
This is the average home price in America right now, $400,000. Actually, kind of threw me off because in the area I live, 400,000 doesn't even get you a townhouse. So this actually kind of surprised me.
Well, that's because they're
Uh,
dividing it by the place I live, where $400,000 is a very, very nice house.
Maybe I need to move where you live.
Mm.
Um, so if you bought a $400,000 house and you took out a 30-year loan with 20% down, and I would say you should always, if you ever are going to buy a house, you want to put 20% down because otherwise they will hit you with something called PMI, which is property mortgage insurance, I believe. And it's basically just a fee that you have to pay until you reach that 20%. So it's just wasted money. There's no benefit to it. So if you are going to buy a house, you want to put 20% down.
Mm. When I bought my first house, I slapped pocket lint and a Mento down on the table, and they hit me with PMI for like 5 years.
Did you really pay PMI?
Oh yeah.
I didn't know that. Do you cry at night thinking about that money that's gone?
Yeah, it wasn't too terrible. I think it was like I don't know, like $150 a month or something. But I do. It is a shame because at the time the mortgage was. I mean, it was my first house. It was $100 some odd thousand home. It was the mortgage was maybe $400 or $500 a month. So the PMI made a big difference.
That's a lot, yeah. Well, and
Yeah,
just $150 to you at that point in your life was a lot of money.
yeah. I think my income with myself and my girlfriend at the time, now my wife, might have been 60 or 70,000. It wasn't a lot, and so that amount of money every month made a difference.
Imagine if you would have just taken that $150 every month, put it into an index fund, and just let it sit there.
Oh,
Think
an
how much it
index
would be
fund.
now.
I know. You're
So
talking my language.
I know I am. So we're gonna look at a 4.5% interest rate. Like I said, this will vary for everybody. Some people probably have 7% right now. Some people have 3%. I feel like this is kind of where the mortgage market will, balance out to somewhere between 4.5 and 5. But I wanted to give it a little bit lower than 5% just to giving the house option here just a little bit more room to breathe per se.
Sure.
So some other costs you need to think about with your house: HOA. This can vary to zero to a couple $100 per month. So
Mm-hmm.
something to think about. Insurance. It can be $500 a year to $2,500 a year for your house. Property taxes. This will change every year. So when you buy your house, they're going to give you a number, and it's going to continually go up. I've never had my property taxes go down yet.
Weird.
Yeah. Maintenance. So your refrigerator breaks, uh, roof leaks, electrical outlet stops working. You got to fix it. All coming out of your pocket. And then fees. Any other fees that come along with the house purchase. Realtor fees. Um, there's just so many fees that come with a house, and it's different per state, per locality. So just some things to think about. Let's go over the numbers in a little bit more depth now. So if you were to buy that $400,000 house, put down the 20%, and you had a 4.5% mortgage, 4.5% interest rate, your mortgage payment would be $1,600.
Okay.
Over 30 years, that breaks out to just under 600,000, 583K. You're going to spend on that mortgage over 30 years.
Mm-hmm.
Your property tax on that, and the property taxes number is going to change wildly depending on which state you live in, which locality. So this could be way different for you. Um, if you're pay so on this is a 1% property tax rate, which puts you at $333 a month, and after 30 years, that will put you at 120,000. Now, something to keep in mind: this $120,000 you're going to pay over the 30 years. This is if that property tax doesn't increase at all.
Ah.
There's no increase to it. This number will be higher. You're probably looking at like 150, 160.
So this
Home insurance.
is
Okay.
this calculation down the line. All of these are assuming no numbers are changing. So that number at the very bottom there is the best case scenario.
Yes.
Okay. Okay.
Yep. Home insurance, $125 a month. Break that out over 30 years, you're looking at 45,000. HOA, $100 a month, looking at $36,000 over 30 years. Other costs, these are like maintenance costs. I just averaged it out to $166 a month, and that you're looking at about 60 grand over the course of 30 years.
Mm.
And then, so your total out of pocket cost per month on your house is going to be 2346.
Okay.
And after 30 years, you've paid $844,000 in your house.
Mm.
I'll be honest, that's a big number when I looked at it. You're paying over double the price you paid for the house. You paid $400,000 for this house.
Mm-hmm.
After 30 years, you've now paid $844,000 for it.
And what's the interest rate on this house again? The
Four and a
mortgage.
half, 4.5%.
4.5. Okay. Okay.
So this is the 30-year breakdown. So this chart just shows you each year and how much you would pay in interest and how much you would pay in principal. And if you look at the top, you notice in your first like 10, 15 years, you're paying more in interest than you are in principal.
Right.
The banks are smart. They do it this way on purpose. They want their money before you get to start putting your money away. So they let you put a little bit of principal away, but that first year you're basically going to spend $20,000. The bank's going to get 15,000 back towards their interest. You're only putting 5,000 away. So a lot of homeowners, when they make that first year of payment, they're like, "Well, I paid $20,000. That's $20,000 set aside." Not really. You're getting probably a quarter of that. Something I know a lot of homeowners also do is they pay extra each month towards the principal. So
Dummies.
when you can actually specify if you have like extra $300 you want to put towards your principal, you can say, "I want this to go towards the principal, and that will go towards the end of your mortgage." So it just starts cutting off the bottom months.
Mm-hmm.
So if you pay off a full year, that last year just disappears. But to pay off 1 year. So if you want to pay off year 30 of your mortgage, you would need to pay $18,991 ahead of time.
Mm.
So, and a lot of people do pay off their mortgage ahead of like start making payments ahead of time. Wouldn't you say, Chip?
Yeah, some people you could say didn't do the math and put, let's say, $30,000 to $45,000 into their home instead of into the market, thinking that maybe debt was a bad thing when they had a 2.9% interest rate. And maybe those people would be idiots. But let's not cast stones in a glass house.
Well, and I mean, if you don't know, you don't know. I'll be honest. Until just the last like couple years, I really started looking into this and realizing, boy, the paying a house off early is actually a really bad thing in most cases. Now, this it's not always a bad thing.
Mm,
If you have a 17% mortgage rate like
right.
they had back in the 80s, well, you're probably better off trying to pay that thing off as quick as you can. But if you have a 5% mortgage rate, the S&P over, a 30-year period averages 10% increase. So if you have your money in the S&P, you're getting 10% versus that 5% you're paying for the interest. So some debt is good debt if it's cheap debt.
Mm-hmm.
But, but hypothetically, if you want to pay off 5 years of your mortgage early here, but you want to pay off these years 26 to 30, you would have to pay $86,972 ahead of time. So, years 1 through 20, you have all this extra money coming in. You pay 86,000, let's say $87,000 ahead of time. You've knocked off 5 years of your mortgage. Sure, that's awesome. 5 years, we're getting rid of some interest payments. We knocked out $10,000 in interest payments. But had you taken that $86,000 and put it into an index fund, I'm talking a safe index fund, S&P, something that very stable. You're
Mm-hmm.
getting on an 8% to 10% return. That's your growth is way more. So you're actually shorting yourself by paying your mortgage in this case ahead of time.
That's interesting. So, this is specifically what I did. So far we haven't decided if buying a house or not buying a house is a good idea, but we can say with some certainty in most market scenarios, even with like a 7% return, as long as your interest rate is lower than the average return of the market, 7%, you're you're better off not paying any additional money towards your mortgage.
Absolutely.
Why?
Yeah.
Wild.
I think even if you're yes. Yeah. I can't think of a reason why you would pay more to it. I mean, you'd have to have a really high interest rate to do it. Um, and I'll be honest, I've done this mistake too. Every month I would pay an extra $100 towards the mortgage. Definitely not a good long-term investment because you're giving the bank money to hold for 15, 20, 25 years depending on how early you're giving it to them.
Mm.
At the end of your mortgage, your house is still going to go up in value no matter whether you pay it off or you don't. The house price just keeps moving. So rushing to pay it off doesn't change anything from that aspect. If you're doing it from an investment standpoint, based on the numbers, you're better off in the market than putting it into paying off the house.
Mm. Do you think that this is a side effect of both of us have similar low income backgrounds, right? We both grew up in
Yep.
somewhat low income families. I feel like amongst low income families, it's constantly iterated that debt is it's a wealth killer. But really, debt is more nuanced than that. And this is a great example of when a more nuanced understanding of what debt is sustainable debt is beneficial to your long-term financial success. And it's something that I think the people who could use that information the most don't receive it.
Yes. Yeah. I mean, there's good debt. This is good debt. You've got a low interest rate, and if you took the same money you were going to rush to pay off this debt and put it in the market, you would make more to pay off the debt actually earlier if you wanted to.
Mm.
So there is good debt, and I think a lot of people are, told, just get a house, pay it off. But rushing to pay it off is actually hurting yourself. So getting a house, because as you mentioned in I think one of the last episodes, there's a lot of social economic factors when it comes to a house, right?
Mm-hmm.
Now, people are looked upon differently if they rent versus buy.
Mm-hmm.
People feel different if they're renting versus buy. Sometimes you don't feel such a sense of security in a rental versus something you own. But if you play your numbers right, if you're renting and you have a $2 million bank account versus someone who owns their house outright but has $10,000 in their bank account, who feels more secure in the long run?
Yeah,
You know?
no, yeah.
And just remember, you technically never really own your house. The state always owns it. That's why they are always hitting you with the property tax.
Mm.
It's never like you make this grand last mortgage payment, and they're like, "Nice, you don't owe us anything ever again." Bills keep coming, right? They just keep piling in, and after 30 years, your house needs all these renovations, and that's not even factored into a 30-year-old house. It does start to appreciate in value a little bit in some instances because it doesn't have the latest technology, probably not the most efficient energy or cooling wise. There's a lot of other factors with the house too.
I'm curious if you get to the slide on here that suggests that we buy one of those teeny homes that I'm always being shown videos for on YouTube.
I'll be honest, I like those teeny homes.
Me too.
Um, but I would probably take out a loan versus paying for it outright. um, so if your $400,000 home appreciates by a 2.5% increase annually, it would be worth approximately $839,000 after 30 years. But you'd have spent $844,000 on it.
Okay. So we're sitting at about break even.
You're basically about break even. Yeah, you didn't really lose. Now, the argument from people who are against renting, they would say, well, whatever you pay in rent is a complete loss.
Okay.
And that there is some argument to whatever you pay your landlord, you're never seeing that back again. That is out the door, never coming back again. Where with the house, you do send money out the door, but it does do a boomerang effect at some point and make its way back to you.
If you live in it for in this instance, 30 years.
Yes. Once you start buying and selling, you throw all of these numbers way off, and it becomes more of a gamble. Did you buy at the right time? Did you sell at the right time? A lot of numbers that are hard to calculate at that point. 30-year cost of renting. So if the rent average of $2,000 a month, I don't know what rent costs for you, Chip. I don't know what a two-bedroom would cost out in your area. In my area, it would actually be more than $2,000, but this is the national average for the country.
Okay.
$2,000 a month with a 3% increase per year. How much would it cost us after 30 years? Ooh. $1.14 million.
Is that assuming what percent increase per year?
3%, I believe this was.
3%.
Yeah,
wow.
3%, yeah.
Ouch. So, okay, so that definitely hurts.
Yeah, that's a big number. We hit a whole new category. But remember, you rented, Chip. You didn't buy. So you took that down payment you were going to use for a house and you put it in an index fund.
Oh, I love index funds.
I know you do. That's like a T-bone steak for you. Just got your mouth watering.
That down payment in an index fund, that's going to be paying real nice right about now, 30 years down the line.
So if you take the 20% down and you put it in the market, after 30 years, that 20% will be worth $1,395,000.
Oh, okay.
Now, if you let it sit there another 5 years, you don't sell it. In this instance, you're thinking of it the same way as your house. You're not going to sell your house right at 30 years, right? You just paid it off and you're going to sell it. You're going to stay a few extra years. So we're going to keep that money in the market for an extra 5 years. After 5 more years, you're at $2.2 million.
Now we're talking.
$2.2 million after leaving there so you don't own a house. You can go anywhere in the world you want to live now because you're not tied down by this house asset that you have to sell and go through all hassle of it. You got $2 million in cash. And what's better is still the question, right? And ultimately, I think financially you're way better to rent, is my opinion. But if you're raising a family and you've got 2 kids and you've got a dog, it comes down to a math problem, right? How much is quality of life versus the dollar amount?
Interesting. Is there any difference between something that this doesn't quite account for, or maybe it does and it's in your calculation? Is there any difference between the average mortgage payment and the average rental payment for a property of an equivalent quality, right? Because I assume that if I wanted to rent my home, it would be much more than if I had a mortgage for my home, correct?
I don't know, actually. And I tried to. The problem is I started off by looking for rental houses versus buying a house and trying to get similar numbers.
Right.
But it's so hard because every area is so different.
Right.
But The one thing that doesn't matter where you live, whatever part of the country you live in, wherever, the index fund is still going to go up at 8%
Right, right.
on average. You're going to make more money generally having your money in an index fund than you are in the house. So, if you have 20%, you're thinking about, should I buy a house? I want it for an investment. If you want to buy a house and you're like, I want it so I can raise my family here, you're not so much concerned about the money aspect of it. Buy the house, raise your family. Life is short. Enjoy it. If you're looking at it from an investment standpoint, terrible investment. Terrible. Put in an index fund.
Hmm. Yeah, that's
Um,
that's interesting. I this whole time I didn't think about the lump sum that a down payment would represent over time when you drop that sucker in the market. I completely ignored that in some of my research, but you're exactly right. It's a pretty expensive change. And I found an interesting chart on NerdWallet, which is a rent versus buy calculator, and it assumes of some very similar numbers to yours, which is a $2,000 monthly cost of either rent or what you would be paying essentially, a purchase price of a home of $415,000 with a down payment of $37,000 and an interest rate of 9%. And they don't start so off right off the rip. Buying a home costs more for the first, I think, let's see here, 3 years. So if you move before 3 years, you've wasted massive amounts of money. That's just with like the interest, the mortgage payment versus the rental cost plus your down payment.
yep.
And over the entire 30-year calculator, they functionally stay more or less the same. It takes 15 years for them to become virtually equal, and then by the 30-year period, they're still within a margin of error of monthly costs of each other. And so I think you're right. Buying a house is completely a quality of life decision. Do you want a dog? Do you want to avoid your neighbors? Do you want two kids? If you're a single person and you like to like choose different areas to live, it seems to me like buying a house is a humongous financial mistake. It would in fact be a wealth killer.
Very bad investment. And if you do buy a house, do not pay early on the mortgage.
Who would do that?
Pay each month. I, people don't realize, like, letting the your lending company hold that money for 30 years. They're making the money you gave them worth more, where you're missing out. So don't pay early. It's definitely something, uh, you know, big financial mistake that I think a lot of people make, myself and Chip included. So
Mm,
something we don't want to see other people make. That's our analysis of buying versus renting. I think ultimately people need to do what's best for their living situation. But either way, there's still some, whether you buy or rent, there's still some really good financial decisions you can make along the way. So, even if buying isn't the best financial decision, you can still do other things while buying the house that are very beneficial to you. So, hopefully everyone pays attention to these numbers, and maybe just recap how you're paying your bills currently and how you're investing your money.
maybe don't pay that principal down.
Definitely don't pay that principal down. And that's it for this week of Bull versus Bear. We'll catch you guys in the next episode.
See ya.